Welcome back to Tracking Trends with Homestay Mason. Today is the first Tracking Trends of the year, and normally I do it on Thursdays, but life happens, right? Life happens. And at Homestay Mason, we have grace with each other because sometimes life happens and sometimes we need to adjust and adapt. And so today is Friday, January 9th, the first Tracking Trends of the year. I promised I would be back after a 2-week hiatus for the holidays. And here we are to talk about what is happening in real estate nationally, as well as more specifically to our local area. We really like to focus on that. I get to that at the end, so make sure you stick around to the end if you want to find out what's happening more locally, hyper locally, in fact. So we start with interest rates. Always people want to know what's happening with interest rates. That always has a big impact on what's happening in the market. So guess what? 6.16 is the average as of yesterday for a 30-year fixed mortgage. That's great news in terms of where we have been, because you can see that the 52-week range has been as high as 7.4 and 6.15 is as low as we've been. We're up a touch from where we were. Oops, let's ignore that. There's my next screen, my next slide. Up a touch. We were 6.15 the week before, so really that's negligible. But compared to last year at the same time, at that time we were at 6.93, right? Almost at 7% at this same time last year. It's a very different time, lots of different things going on at that time. So I feel good about being at 6.15 right now. I think that is good for the market and good for buyers. In national economic news, what I see here is generally, I think, good news as well. What I see here, the median home price rose in November, and this is nationally, remember, according to National Association of Realtors, home prices were up more than 50% since 2019. It's a really big number, people. More than 50% home prices were up since 2019. So while you will see in our local data, prices have kind of, I would say, stabilized and might be coming down a touch, but the big picture here, folks, which is why we look at the big picture and look at the hyperlocal picture, big picture is the market is healthy. Pending home sales were up in November by 3.3%, higher than expected. And again, the house prices were up month over month in October as well, higher than October of the year before. As well, the Case-Shiller Home Index showed increase in prices month over month. So lots of signs that prices are up overall. And good news in the jobless market as well, or the job market. So jobless claims were down. And so both continuing jobless claims and initial jobless claims, both down. So that's good news in the labor market. So to me, all of these signs are, I think, positive for the market, except for, I guess, prices going up. I mean, that's just the way it is, especially in our market. Prices generally go up year over year, which is why owning a home is a smart investment, because the sooner you get in, the sooner you start building equity, and then you can tap into that equity later. So again, I think in general, that's good for buyers. Looking at the region, the Mid-Atlantic region, which includes Virginia, DC, Maryland, Pennsylvania, West Virginia, Delaware, and New Jersey, median list price here was down. 1.7% decrease from the same week last year. Price growth has slowed in our area. Not a ton, and that's, just right now. So again, I'm not concerned about that. And no, supply is healthier than it was last year. Inventory has been increasing throughout 2025. And so as of right now, still seeing that. And if you watch me week over week, an increase in inventory has not been a bad thing. We have needed that. We did not have enough supply. So we've needed more supplies. So that is generally also a good thing. New contracts are at their lowest level in at least 5 years. So that is a sign of lower buyer activity. And if that does continue, then that could reduce prices and could not be good for sellers. But I think it's too soon to say with these other signs. I think that I'm expecting, as of right now, generally a normal market like what we normally see. That's what I'm anticipating. I could be wrong. In the DC metro area specifically, looking at the week over week data here, kind of irrelevant because we're comparing to the end of the year, the last week of the year. Obviously not a lot of real estate is happening at the end of the year. So week over week, sure, things are up. All of those things are up because not much happened at the last week of the year. But then when we compare to a year ago, that is a more relevant comparison today because we're looking at, okay, the first week of the year last year, what did it look like compared to the first week of the year this year? How does that compare? What does that tell us? So showings were down compared to a year ago by 5.2%, but purchase contracts were up 6.7%. Time to contracts up 6 days, 53 days. I think that's the longest I've ever seen in my 16-year career. So I wonder if that will come down. I mean, again, normally this time of year, more and more buyers are coming on the market, more and more competition will happen, and that day I will expect those days on market to shrink. We'll see. New listings down from last year, in this case, 12.5%, and list price, in this case, down 5.1% compared to last year. Active listings are up 25%, almost 26% compared to last year. Our hyperlocal data we look at here at Homestead Mason, we run Arlington, Alexandria, Fairfax, and Falls Church, where we do most of our business. So we run that data manually each week to share here with you. And so this chart, it gets bigger and bigger, obviously, as the year goes on. So we've got 1 week to show you right now. This is the raw data of new listings and new under contracts for the first week of the year. So what you can see is that there were slightly more listings than under contracts, which is our demand to supply ratio we'll look at in a couple of slides. Compared to the week before, again, this totally makes sense. So 200% more inventory than the week before, and a touch more contracts than the week before. That demand to supply ratio I mentioned. So this is a chart from last year because, again, we don't have a lot of comparison yet. And so here we go. The demand to supply ratio, oops, I thought this was 2025. Let me just check my numbers here. 2025, 75.66. So this is the right number for 2025. We just forgot to change this here. So 78.3% demand to supply this year compared to 75%. So obviously that's like right on mark in terms of where we were last year in 2025. That demand to supply ratio is a measure of how many contracts were written compared to how many homes were listed, which indicates a bit how many homes were left over, right? If the same number of contracts were written as the same number of listings, it would be 100% demand to supply ratio. So we're, under 100%, 75%. That leaves some homes left over. It's not a bad amount of demand for the first week of the year. And then our days on market, I think we were at 43. I've got the raw data over here. 42 is our average days on market in our hyperlocal area. So that's shorter than we saw in the larger DC metro area. And you can see days on market did increase. That increased generally with more inventory. And I will expect that number to shorten, as I talked about earlier. So those are your trends as of today, the first week of the year. Thank you for watching, and I will be back on track next week. And please join me and share with others if you do value this information. Please, tell people wherever you're watching this that they can watch it there too, or connect them with us and we can get them linked in to make sure that they get this as well. So thanks for watching and have a great weekend.